Welcome to our Q3 Asia Trade Floor update with Portfolio Manager Stephen Chang. We've been seeing ongoing shifts in the global landscape. Today, we're going to discuss how investors can navigate these changes. Stephen, let's start with China. The global order is clearly moving towards a multipolar structure marked by tariffs and trade uncertainties. How's the outlook for China's economy evolving?
We expect China growth to stabilize in the high 4% range in 2025, then slow to about 4% in 2026. The first half of this year saw growth close to 5%, but exports and household spending are expected to slow. To support growth, the government will likely boost infrastructure investment. Inflation remains low, with weak construction demand and falling oil prices putting downward pressure on prices. Policy rate cuts are expected but somewhat delayed, given still decent growth data in the first half. We expect a 20 basis point cut in 2025 to 1.2% and another 10 basis point in 2026. Credit easing will support key sectors like technology, services, elderly care, and export-focused businesses. Fiscal policy will use more central government debt to boost household and government spending, including infrastructure, consumer goods trades-in, equipment purchases, and bank recapitalization. Fiscal deficits are expected to rise above 12% of GDP in 2025, from 10.3% in 2024.
How is China's growth model changing in the longer term?
China is shifting from property and infrastructure-led growth to one focused on consumption, manufacturing, and technology. But high debt and an aging population will continue to weigh on growth and inflation. Monetary policy easing will include measures like buying bonds, as well as targeted credit support to key areas such as technology, property, agriculture, service consumption, and elderly care. On the fiscal side, the central government will need to increase broad-based stimulus while addressing local government debt problems. Pension increases to help consumption and reforms of state-owned enterprises may improve fiscal effectiveness. China remains a key global manufacturing hub. It is upgrading industries and reshaping supply chains, focusing on technology self-reliance and securing food and energy. It is also expanding trade with emerging markets to manage geopolitical risks.
So what does this mean for the rest of the world?
For emerging markets, China's new growth model probably won't bring many spillover benefits. In fact, it could mean more competition in local industry, which might lead to more trade disputes. China is also facing a deflationary environment. With its huge manufacturing capacity seeing less demand from the United States consumers, we can expect some downward pressure on global prices.
So Stephen, despite some challenges, we're seeing a positive environment for many emerging markets. What's driving this strong momentum?
Emerging markets are benefiting from a weaker US dollar and shifting investor sentiment away from the United States. This is leading to strong inflow into emerging market equities and local currency bonds. Many emerging economies have kept their debt at manageable levels, which helps them handle potential risks. Many central banks are cutting interest rates to support growth. This is helping to create a virtuous cycle of growth and investments. Meanwhile, the rise of digital currencies and stablecoins, which often hold U.S. treasuries, is changing capital flows and currency management in emerging markets. This could reshape investment dynamics going forward.
And how will this reshape investors' allocations?
There are strong opportunities across equities and fixed income outside the U.S., especially given the low ownership level in these markets. The ongoing capital reallocation away from the U.S., supported by fiscal stimulus and a weaker dollar, sets the stage for sustained growth and attractive returns.
Let's look beyond Asia and emerging markets. How do you see the global economic outlook shaping up?
The global economy faces opportunities and challenges. Many central banks are shifting their focus to supporting growth through monetary policy rather than just controlling inflation. This is partly because fiscal space is limited due to high debt and deficits. We remain positive on duration in fixed income, seeing value in medium-term bonds as central banks have more room to cut rates. At the same time, geopolitical tension, and trade uncertainties persist. Investor must balance these factors carefully while seeking opportunities in sector and regions benefiting from long-term trends like technology innovation and fiscal investment.
What's the key takeaway for investors as we look ahead?
Diversification is essential. With growth prospects uneven, investors should consider a broad range of markets and asset classes, focusing on quality and emerging trends. Staying flexible and aware of evolving risks will be crucial to navigating this complex environment.
Thank you, Stephen. For a deeper dive into these themes and how to position your portfolio, be sure to check out our latest secular outlook, The Fragmentation Era, on PIMCO.com.